Hi, Mish. How you doing?
I'm doing great. How are you?
Good. So I don't think, have you been on with me during a number? Have you been on with me for an economic number? You're going to think you're right down at where were you at the NYMEX or
For part of the time, yeah.
yeah, yeah. So this is the only time I go to my 1 minute chart because 1 minute charts make me nervous. I just don't, and tick charts even make me more nervous. So I go to the 1 minute, and we're coming up a B. Why don't you give us a 15-second preview here of the number?
Preview of the number, we're looking for a U.S. unemployment rate of 3.8%. That would be unchanged from the March report of 3.8%. We're looking for 240,000 jobs. That's against 300,000 the previous month. U.S. hourly wages are expected to maintain at 0.3%. There you go. There's your 15-second preview.
Okay, the algo jumpers are jumping their algos. They're removing their bids and offers. Little small move up. Haven't taken out the pre-market high yet. Pre-market high is 51.18. 26.75 is your number on the upside, and we're going to be there. We are past there. We're coming in with a good number here, folks. The market is loving this number, whatever the hell it is. It must be in line or soft. What do you got? Nice pop.
U.S. unemployment rate for April, 3.9% versus 3.8% estimated. The hourly earnings for April, 0.2% versus the 0.3%. So 0.2 versus 0.3 on hourly wages. That's good news for inflation. Unemployment rate actually ticking higher to 3.9%. U.S. unemployment rate for April, U6. I don't know what that means. I don't know if that's a typo. Unemployment rate for April, 7.4% versus 7.3% prior. So maybe some signs the labor market's cooling down. I think more importantly, you're seeing that wage growth come in a little bit lighter than the market was expecting, which again, usually trickles down to meaning that, people are spending less money, which can help inflation. So nothing crazy in terms of the misses or how light it came in, but I think just the fact that it is coming in slightly light, the market is loving right now.
All right, just real quick. We are back at the highs for the week, folks. Just like that. Our high on Monday was 51.48.50. You know what happened on Tuesday and Wednesday after that. So I'm gonna look for another resistance level. I'm gonna go back to a normal chart, and let's be sure already here. We did a lot of talking. Is this what Mr. Powell wants?
Well, it's certainly in the right direction. And he said this week exactly what the market needed to hear was that he may not necessarily raise the rates, but his next move would most likely be to lower the rates. And so that's why we've gotten the rally over the last couple of days. And now today's jobs number, clearly, at least the initial reaction is, okay, that means that Powell can actually go ahead with all of that. And there's also been talk about Operation Twist, which is something we haven't really seen in a long, long time. It was in 2008, 2009. And that's where they decrease the yields at a faster rate on the long end than they do on the short end, but it doesn't mean that they have to raise the rates. So in essence, what they do is they flatten out the curve. And it's a good way, or at least it was effective after the big crash in 2008, to stabilize the economy. And the only negative part of that, of course, would be the high interest rate that we're paying for debt right now, or that they're paying for the government debt, which of course continues to go up. Will that help? Maybe not. But at least for the short term, that twist is something I think that's being tossed around. And clearly today would help that happen.
All right. Well, that's a great breakdown of it. Bad news, good news scenario here. Folks, keep an eye on that 48.50. That was Monday's high. We did get to 50.75, so that was actually the top number I have. That's what I'll be focusing on. So we exchanged some notes, and we've been talking the whole week how, man, if you ain't fading, you ain't trading. And you've had some quick drops, and earlier in the week, put a double bottom in on Wednesday and Thursday. You've had some quick pops here, and they've been faded too. Sell in May or just chop around in May. And if you're into selling rips, we're kind of looking at one right now.
Well, yeah, I mean, there's certainly, we don't really know yet whether CHOP's going to be the ticket for May. And I think you have to really look at the market individually. And that's really been helpful when you do that. So that always brings me, Joel, back to my Modern Family, right? So I know you're watching the SPY and the SPX, but of course, we're always focused on the Russells. And what's so interesting about the Russells right now is that the last couple of days they got to 200. Well, it was last week, and then again yesterday they got close to 200 in the IWM and stalled. So I think that we may still be range bound, but over 200 in the Russell means that we could see a nice pop back to at least test their highs, which was around 210. And then we'll see what happens from there. Of course, any kind of relaxation of the yields would help the small caps in particular, right? Because so many of those stocks have gotten hammered with higher interest rates and higher inflation, so higher costs. And that's kind of what I'm looking at, all of the sectors. The other one, of course, it's really important to me right now. Granny retail is always important. And we saw terrible consumer confidence, but yet that whole sector held key support. But it's transportation that was selling off in the face of the rally, and now also managed to find some major support on the weekly chart over 63.30. And if it gets back over 67 in IYT, I think that would be hard to argue with. And we can't forget we're in an election year. So regardless of everything's going on, I think the Fed made their decision. They're not going to worry so much about inflation, and they're going to be more worried about the potential of recession, especially after today. And that could actually help some of these sectors that have been underperforming.
Mish, so speaking about, looking at the market individually, what about what's going on in the semiconductor industry right now? You had SMCI and AMD report this week, which caused a lot of those stocks to kind of be pulled in a little bit. Do you think this is a bubble bursting or a buying opportunity?
It's very possible it could be neither. It could be that the whole semiconductor space is trying to find its legitimate value. And I think the best analogy to that would be what happened with electric cars. We know that EVs went nuts. They were all the rage. At one point before Tesla split, it was up at 1,000. And so then, of course, we've seen the great decline. And now after the split, Tesla was a 5-to-1 split, is trading at around 179, having been at 140. So the reason why I bring that up is because it's not really known yet, I think, to the market exactly what is the right value for some of these companies. And we're going to see NVIDIA in a couple of weeks. I think it's May 22nd. But we've seen, Google did great. But like you mentioned, AMD did not do so great. I know QCOM went up big yesterday, which of course also helped Apple, and they didn't really mention too much about that association. But the point is that I don't think we really know. And I do believe that it got a little too long in the tooth in terms of the valuations. And so what's a buy opportunity? I'd like to see what happens in NVIDIA if it can't get back through, let's say, 865, which was kind of a monthly breakdown number. Maybe it goes down back to 700 or so, and then that's probably more of a fair value. It's not the area that I'm really all that interested in trading right now.
All right, well, let's look at another sector then, one that's been kind of heating up a little bit. It looks like uranium, and people are kind of starting to like this nuclear story a little bit more. How are you trading this?
Well, we got long uranium on the discretionary side of our model because, well, even before the story came out, yes, I know what you just mentioned is true, but there are two other stories that really have impacted uranium. Number one is that it came out that AI actually, I'm sorry, AI, that's natural gas. I'm getting ahead of myself. Let me switch commodities here. I've got so many commodities in my head. With uranium, it was that Russia was sanctioned and they produced 25% of the uranium. And so if we're sanctioning Russia on uranium, that, of course, is a boost to uranium. And then add what you just said about the potential of nuclear energy. And uranium was a little bit undervalued. So now it's trading over 30 on URA if you're looking at that. 29 was a really good breakout. And I see no reason why it can't head up closer to maybe 40 before it starts to run into some major resistance.
Talk about drugs here. We talk about a AI bubble, different things. I mean, everyone's getting Lilly's just had a tremendous run here. Amgen comes in today. They're getting into to the obesity drug as well here. I mean, are these just taking a look? Something like Pfizer is really beat up. Are these just like just not sexy, just like not the place to be unless you're in, one of the hot rods or Lilly or NVO. What are you looking at in the drug sector?
Well, Amgen, I heard you talking about it, the diet drug. So that's really been my whole theme. I've kind of phrased it as the vanity trade, where the consumer spending habits are shifting from going out and traveling to really more taking care of themselves. And as that trend continues, if these diet drugs become more affordable, because right now they're pretty expensive, and then therefore more mass adaptable, then I think that's going to have a big impact, not just on the drug companies that are really involved, like Novo Nordisk and Amgen and Eli Lilly, but then also some of the other companies that would benefit for people feeling better about themselves. So we've talked a lot about some of the beauty companies or skincare companies. I've been watching AbbVie, but AbbVie actually also has come down, which is I think is good because it was a little expensive, but around 150, something like that looks really compelling. So, so, so here's the thing. Amgen did great, and you mentioned Pfizer. I felt that Pfizer at $25 kind of bottomed out. It's not a sexy drug company by any means, but it's doing well. And one, now that it's come off, it's gotten all the way up close to what, 28, or even maybe took out 28. That's a nice move for a very quiet company. And it's possible that that would be something that would continue to move, especially if you look at Moderna, which had a huge move after earnings, partly because of the RSV vaccine. So I think there's opportunity there, but like everything else, you have to be somewhat selective with what's the macro theme that's involved with that particular drug company.
All right. Well, let's, kind of stepping back, we got this jobs number this morning. What do you think about what the Fed's doing right now? Do you think it's going to end up ditching its 2% inflation target? Do you think this, the fact that they're slowing down the quantitative tightening is a big deal?
That's a great question because one of the other things that Powell said, and he didn't say it emphatically, but 2% doesn't seem very tenable at this point. And so it was maybe the first time we've heard the potential that either A, they ignore that target, or B, at some point they say, well, maybe we should be looking more at a 3% inflation target than a 2%, given just the overall growth of everything in the economy. When I say that, I don't mean that the economy is incredibly strong, but it has certainly grown from when they used the measure of 2%. So, I go back and forth. Sometimes I think, oh my God, they are really ignoring this potential inflation rise. Today, the wages came off a little bit, so maybe that's, somewhat of a relief on the inflation narrative. But I think they're going to have to change their minds on that 2% target just based on modern times. So yeah, I mean, he's so far keeping a cool head in the face of a lot of interesting variables.
Isn't it amazing where how quickly the narrative changes in the market? We were old, the hotter than expected CPI and PPI, and then what the heck with the employment cost index? Tell me about the employment cost index, Mish. Did you have that as one of your primary economic indicators as something to keep an eye on? I guess that was the same day that Meta came out. But can the narrative just keep changing this positive negative positive negative positive negative? When are we going to get some stability?
Well, I'm glad you brought that up because that was the day when all of a sudden the term stagflation was Google searched at a spike for the first time in a really long time. And that was the classic look of stagflation, right? Because you had some shrinking in terms of growth, but then you had the costs going way up. That's classic. And Meta, what Zuckerberg said, I thought was really interesting. in that he said that the costs of doing business and staying competitive are going to rise in order for them to really keep themselves up as a premier company. When all of their research with metaverse and AI, they're going to have to spend more money in R&D. So that's exactly goes back to the first point, is where does all of this find valuation in terms of the rates, the costs, the inflation, and valuation? So that employment cost was indicative, and so far we're still seeing those signs of stagflation. So in terms of stability of the market, perhaps this, like you said, loosening of the QT, maybe the operation twist that comes, maybe even potential a rate reduction as we get into the summer. These are good things and not such good things, because we don't want the Fed to all of a sudden start to flash that they're worried about the economy. Right now, they've been very confident about the economy. So that's why we're not going to see any stability anytime soon. But that doesn't mean we can't see massive rallies, because the retail space loves to pile into this market when it can.
What about small caps, Mish? You looking at IWM here? What's your take on IWM? Been kind of still lagging behind the overall market here in 2024.
Yeah, it's for a long time. It's been lagging behind the overall market. And that's why I mentioned it earlier, because with the small caps, again, there are going to be pockets that would find any kind of flattening of the yield curve, so to speak, as a relief, and it might help companies that have been struggling. And also there's been somewhat of a rotation in the last couple of weeks to value from growth. So that helps our dear granddaddy IWM. I think if it gets through 200, as scary as that might sound, you've got a pretty good risk. You can even take about a $10 or $15 risk and see if it can't take through that 210 and maybe work its way up to new highs. That could be the sleeper opportunity, but I'm very patient about it.
Yeah, we've been saying that for a long time. Mish Schneider, Chief Strategist at Market Gauge, longtime guest on our show, giving us great input not only on stock, but interest rates and the commodity markets. Mish, thanks for joining us for that number, and we'll be dialing you up again real soon. Thanks for coming on.
Thank you, guys. Have a great weekend.
You do the same, Mish.